Welcome to Semper's post-budget debrief. We're not long from listening to Rachel Reeves's first budget speech. I'm here today with Pete Roster, our head of tax at Semper, Dave Winchurch, Director of Win Financial, and Mark Finucane, Director of Semper Commercial Finance. And today we're going to all share our views on the announcements that we've seen so far from the budget today. Welcome everybody. Thanks for joining us. I think it was very much pitched as probably one of the biggest budgets for a long time, and certainly we're going to look at this from a kind of client, business owner perspective, because it's predominantly what the types of clients that we deal with, and certainly business owners have been asked to take large responsibility for the recovery that we're going to see. Certainly. If you look at some of the headline tax changes, are certainly affecting business owners and employers alike. So, we've seen employers and I go up to 15%. We've seen the employment allowance go up beyond 10,800, which is a positive. Corporation tax stay the same for the life of the Parliament. The secondary limit drop to £5,000 from about 9,100. And the national living wage increases at all levels, as well as the future alignment of the adult wage for the 18-year-olds plus. So I guess it'd be really interesting to hear your views just on how you think employers and business owners out there are going to receive that news today.
So from my perspective, I think business owners will have 2 points to this. It'll be how they get remunerated and does anything change, and then secondly, employing staff on minimum wage, is it still viable? Is there any adverse consequences to the increases in rates and therefore more costs? So the increases in costs and the minimum wage increase will obviously increase the amount the employer will pay. There is some silver lining that the employers NI allowance will be increased this year, so for a lot of smaller sized businesses that will have a kind of counter effect to some of those increases, but as you get larger businesses, then I think we'll see quite big differences from how employers are paid, how the owner-managed business owners of the business are actually paid themselves. We'll have to just do some calculations to whether or not it makes any difference, but it looks like it could do a little bit with the reduction of the secondary class national insurance threshold reducing to £5,000. Yeah. But I don't think it's going to make any massive impact to how they do get remunerated at the moment.
Dave, as an employee yourself, how do you feel about the changes?
I think it makes me nervous. I'd like to grow the business and employ more people, and I think it's making me a little bit more nervous, especially as the apprentice rate's going up from £6.40 to £7.55, which is a rate which is something I've thought about doing, potentially hiring an apprentice, getting them in the business at a younger age to do things the way I want them to do and use a process. It just makes me nervous now that the extra costings I'm going to have with the increase in the apprentice rate and the increase in national insurance.
And Mark, from your side, how do you feel that's going to be received by your sort of client base or business owners?
I think clearly the fiscal black hole has landed squarely at the door of the business owners. Obviously they've got higher costs that aligned with increased workers' rights. It clearly isn't a budget aimed at business owners. The only positive element I take from it is that it could actually have been worse.
And I think we'll probably see that across some of the tax announcements, won't we? What do you guys feel, though, is obviously the fact that there's a big change there around employment costs? Do you see employers maybe looking at other options, whether that be overseas contractors or contractors in general, or even AI in terms of future investment? Rather than invest in people in the future, they'll actually invest in cheaper ways of getting work done, rather than look at that kind of cultural infrastructure piece of having real infrastructure in the UK.
I always think that it's too early at this juncture to come out with alternative strategies or solutions. But I think there are definitely options that will be explored over time. An increase in part-time working gives flexibility to employers. My biggest concern, I think, are for those small businesses that are probably on the cusp at the moment. They're just about making enough to continue trading, to continue to exist. And the danger is that these sorts of measures can actually then dip them into the red. And it's being able to support those businesses through a transitional period, whilst with any budget like this, it's the paperwork, it's the white papers that follow, it's the detail that matters. And once you've absorbed that information, then I think it's advisors like Sempar, who can actually then go out with some ideas and suggestions to clients saying, have you considered this, have you considered that, as opposed to a more traditional taking on a new employee. Well, have you considered actually, there's been some real success stories in the past where businesses have taken on apprenticeships and developed, really good people, good fit for the business that have been developed. Is that something, and I know it's something that's been very positively used over the last few years, but is that an area? So I think to be successful in business, quite often it's finding the middle ground, the alternative way to get the solution, as opposed to hiring at a fixed cost a new employee that now carries these additional burdens.
And I think you'll see that as businesses, digest this information and like you say, as they reach out for advice, that those that are most agile will change direction, will look for those angles of either efficiencies or cost savings.
Innovation.
I think it's helped me answer the question whether if I employ an advisor now, do I do it on a self-employed basis or employed basis. It's really pushed me to do self-employed basis, where I don't incur the cost.
Yeah.
And I suppose from that employee perspective, when you're employing someone at a higher wage, there's more expectation, and therefore will the people on those minimum wage actually be not given the benefit of doubt and trained, and they can't be supported in the business because actually they need to be making more money straight away, because they need to have a return on the investment, especially for those smaller businesses that are just on that cusp, as you mentioned, Mark, that are they going to go, well, if this person doesn't work in 1 month, I need to change it, whereas they may have given them 3 months or 4 months to keep it to and so there might be some sorts of things
So I would expect an immediate reaction is if you looked at the employment figures for the next quarter, they will go down. New hires will be impacted on this, whilst businesses absorb the new regulations, take time in making decisions where previously they might have taken on a new employee, maybe prematurely, maybe not, but now I think business owners will take a little longer to make those decisions, to make sure it's the right decision. So I think there will be a period of adjustment to this, and then things will, as business owners adapt.
And the business owner responsibility doesn't just end there. Obviously, we've seen the changes to CGT. Obviously, I think on the lead up to this budget, capital gains tax was really prevalent in the press of how the changes were going to come in. There was rates that we heard mooted of 45 and 39%. And obviously capital gains tax affects business owners as they come to look at succession and exit. And we've seen the rates change, be announced today, to change from 10 to 18% and 20 to 24% on the lower and higher levels. The residential rates staying the same, but bring in line with that. So the residential rates are now in line with the lower and the upper levels. And we're seeing the good news that what was entrepreneurs relief, but business asset disposal relief, is here to stay. As the Chancellor muted it, but we know it's going over the next two or three tax years. So as it goes from 10 to 14 to 18%. Pete, as our sort of head of tax, can you give us your opinions on that announcement?
Yeah, so I think as a lot of the budget wasn't as bad as first feared, like you mentioned. There's still time to be able to do stuff with the business asset disposal relief, especially doing it if you're thinking about doing something in the next couple of years, bringing it in forward to actually create that taxable event, I think is still a possibility, and there's still some benefits to doing that, but I don't think it's now, with tax rates not going quite as high, I think you've got to do it for all reasons and possibilities rather than just a tax motive, which I think some people would have been worried about, that they were needing to do something now purely for tax purposes and saving half the amount of tax. You can still plan, it's still lower than inheritance tax, which I think was very important, because if they'd increased it to that higher level, there would have been no incentive to get rid of an asset. You may as well just keep hold of an asset until you pass away. So there is still benefits of passing down assets in your lifetime and selling property, especially not going up, I think is beneficial to keep the property market moving.
Mark, Dave, anything on the CGT changes just from a property perspective?
I think some portfolio landlords might start offloading some of their properties potentially.
I think definitely seeing that, some of them, we've seen the market change anyway, haven't we? We've seen lots go to put their properties to market. I guess that will still continue.
It endorse what Peter said, really. I think that, business owners who are coming near to where they're making those decisions to exit, that might drive some transactions forward with an eye on the tax increase, especially to 18%. 14% might be deemed to be more palatable, and to allow for a managed sale, 10% is better than 14%. So I think it will come in that, because numbers always come into the decision-making process, and that will facilitate that. I think the only other comment I would make is it could have been worse.
I think if you were a business owner going into this budget with the view that you're likely to sell your business in the next 2 years, I think you've been really nervous about what the net outcome of that sale would have been to you, especially what gone on in the press. I think where we've ended up is actually okay. I don't think it's, everyone would say, well, where we were was better, but it's actually okay. It gives you time to make those decisions, it gives you time to plan.
Well, there were a number of business sales that were trying to take place before the budget, and those that didn't quite get within those parameters, there will be probably a sigh of relief to say, well, actually, we've got a period of grace where the relief remains the same, and takes the pressure off to get those across the line.
So we move on from capital gains tax to inheritance tax. And the Chancellor went very swiftly through inheritance tax. I thought she announced a few things and moved on as if they were largely immaterial, but I feel like the changes that they've brought in are largely on material, really, in terms of the impact, and will affect everybody differently. But in summary, we had the changes to pensions. They're now being brought inside your estate for inheritance tax. In terms of agricultural property relief, changes as well. So, Pete, from your perspective, do you see them as big changes really in what she announced?
Especially the pension, I think that is a big one. I think there's been a lot of advice and where it's talking about moving stuff into pension to remove it from inheritance tax and pass it down family. With that coming back in, I think not only is that going to become taxable, but it could take quite a lot of estates above the £2 million threshold for the IHT taper residential nil rate band. But I think this is definitely one where the white paper coming out, finding out the nitty gritty of the detail, I think there'll be a lot more in that than what was said today. Because I think there's quite a lot of nuances in terms of how it will be worked out, how is there going to be a double tax charge on inheritance tax and then income tax on a pension, and things like that. So I think that will come out in the next few days.
There's obviously some legalities to resolve, isn't there, in terms of how pensions are currently written and how pensions have been written, in terms of that they're usually written as if they're not inside the estate anyway, and how that's going to come into force legally as a tax law. So it'd be interesting to see how.
I think there'll definitely be a lot of conversations around the strategy going forward, which I think will be different, and it might be taking the 25%, which they didn't mention in the budget, which I think was one thing that was rumoured to happen.
Yeah.
So
that's
good.
that's the tax-free lump sum, 25%.
Yeah, so that's wasn't mentioned. So that's being able to still take that, I think, is beneficial.
Yeah.
And it's whether people bring that forward and take that whole lump sum, so that they can do something with the cash.
I think it's interesting, isn't it? Because over the last 5 to 10 years, there's been a lot of planning around pensions because they were so tax friendly in terms of that, they were outside of your estate for IST, but also we've seen the limits of what business owners can contribute to their pensions go up. We've seen the freedom of how people can deal with their pensions into retirement. So pensions have been largely a positive tool, and because of that, entrepreneurs have come back to planning with pensions. So I think there'll be quite a few business owners out there largely a bit frustrated that they've committed to a plan around pensions that now, at the tail end of it, will have a bit of a sting in it.
Yeah, I mean, they may have their property that they run their business from, so they might not have cash in their pension, but they might have the property, and then that will all come inside estate for inheritance tax. So I think I think it'd be a very complicated how it all plays out.
Well, we'll keep everyone posted on that, won't we? So that's great. And then finally, the last change that we feel like landlords over the last few years have been hit pretty hard from tax rule changes, and this budget wasn't without one for landlords, which was the stamp duty change on second homes from 3 to 5%. Dave, how do you think that's going to affect your customer base?
I think it's going to slow a lot of the buy-to-let landlords down. It's just started to increase this year from last year. We're starting to see portfolio landlords starting to buy again. In the past 8 to 8 months, I can see that slowing down completely. Potentially getting rid of some properties as well with the capital gains tax. And then it's twofold, I suppose. I think that will help the first-time buyers if they're getting rid of their properties. They said about the affordable homes, didn't they, as well? There's going to be a boost to that, so I can see the first-time buyer market potentially increasing a little bit and things moving that way, but the buy-to-let landlord is definitely being penalised at the moment to allow for the first-time buyers to get on the market.
Mark?
The buy-to-let model has been unattractive for the last couple of years, I think, isn't it? Which has been a combination of regulatory involvement, higher rates,
Stress rates being really high.
Stress rates with the lenders, which has made the model. If you looked at the buy-to-let model per se, for a landlord who's borrowing sort of a reasonably large chunk, the model didn't work. And we've seen over a period of time a lot of landlords have decided to come out of that. So there's and predominantly, of course, the landlord population are middle class people with a number of properties that they've used their funds to purchase. You've got the professional landlords who get that, where they've got a lot of properties. And then with the reduction in interest rates recently, the model started to become attractive again. But I just think that the 2% stamp duty, and bear in mind the 2% stamp duty was not just aimed at the buy-to-let market, it impacts the buy-to-let market also on second homes. And I think, people buying holiday homes, I don't overly think the additional 2% is going to put them off. They've got the wherewithal to buy a holiday home, a second home, then, those transactions may well still proceed. The holiday let model has also been impacted. So I think overall that will dampen down the investor-led purchases of residential properties. What's the space on that one, I think?
But don't you think we need residential buy-to-let landlords anyway? So not everybody wants to purchase property in the UK, do they?
I think that's a really good argument, because if you sort of said you have a finite resource of 1 million properties, what's the right mix between owner-occupied and buy-to-lets? And obviously, as the landlords sell their properties, and there are a lot of transactions between landlords, they're usually off-market, because a lot of landlords don't like the world to know how much they've sold their properties for. So portfolios are quite often sold intra-landlords, off-market, very much on the QT. But if those don't go to landlords, then they'll go to owner-occupiers, which reduces the number of rentals available, and that largely, as well as interest rates, has driven up the rental yields. to make the buy-to-let model more attractive again, because as yields have gone up significantly, it started to look attractive. So I think it's a fine balance, but I think, you know, if you've got less landlords, there will be less rentals available. So people who can't afford to get on the housing ladder are going to have less choice, where you're seeing examples now of properties going up on the market, and within an hour or two you've got 20 viewings.
Yeah, and if you're an employee, someone coming out of university or thinking move into a different city to work, you're not going to go and buy a house straight away, are you? You want to rent. You want. You know, there are a lot of people in this country that need to rent rather than.
Well, the owner-occupied model, of course, is you need such a significant deposit that, you know, there are instances where the rental is more than the mortgage would cost you. But because you don't have the deposit, you can't afford to buy the house. So you have to go onto the rental market, and you're very much, you know, at the mercy of availability of properties at that time.
I think what you might see is lenders starting to change the minimum deposit levels potentially to help people get on the market.
That's already happening.
So
they're creeping back up again.
There's a couple who had skipped and potentially do 100% mortgage, depending on what if you rented for a period of time. I think Accord, off the top of my head, did £5,000 minimum deposit. So I think lenders have got to be more creative with products they offer to open it up to people who can't get rental. But
you've also seen, like in recent years, because of the financial crisis, in terms of the interest rates, you've seen rent redress anyway, haven't we? We've seen rent levels being reset because they were kept suppressed for too long, because landlords haven't got a big financial cost of owning that property. As soon as that adjusted, obviously landlords have tried to put rents up to cover mortgage, because we've probably got a lot of landlords sat in negative deficit with their rental to borrowing costs. So the market's moved on as well, so even people choosing to rent are now facing higher costs, and obviously if we're seeing increased taxes and entry costs to landlords, that's going to increase rent across the board, isn't it? So.
In any market there are winners and there are losers. In the landlord market, in the buy-to-let market, if you buy right, then there is a real chance that you will be successful. It's all about the yield. So if you look at, you know, Stoke-on-Trent, for example, the yields are quite good when you compare it to London or Liverpool or some of the other hotspots around the UK. So as in any business, there is opportunity, but you've got to do your market research. You've got to know your market. You've got to, you know, when an opportunity presents itself, you have to be quick. But it's not as attractive an investment as it once was, and I think that's the difficulty.
Yeah, because it was always, when business owners created cash and they addressed quality of life, usually property was the next investment, wasn't it? And obviously nowadays that probably is probably
not as
down the ladder a little bit.
Even the capital appreciation is probably going to take a little bit of a back step.
Well, thanks all for joining us. This was a great debrief on what was a budget that, I think you've said it a couple of times, not as bad as it could have been.
I think what I found from the budget was that it was actually quite positive. It was more positive in terms of the language, and whether Rachel had been listening to some of the feedback, but both she and Keir were very positive. They put a lot of emphasis on the OBR, and that as a body, of course, has not been renowned for the accuracy of its forecast, but they put a lot of play on that, which I think was them speaking directly to the money markets, not to spook the money markets, which would increase the cost of borrowing to the government. And I think they've probably got the balance right. The proof will be in the pudding, because David and I were talking earlier about, you know, the potential of a reduction in base rate next week of at least 25 bips, possibly 50, but I would sort of say 25 next week, 25 by the end of the year. We've got the American election next week, that may well have an impact, but if the money markets respond well to the budget, there should be a reduction in interest rates next Thursday of 0.25%. At least, but probably more than that might be a bit ambitious at the moment. Would you agree?
Yeah, 0.25% this next week, and I think before Christmas another one as well.
If we don't, the market's reacting adversely to the budget. That's where I would say.
Okay. Well, thanks all for joining us. And I think definitely Rachel Reeves has left us with quite a lot of food for thought, especially from a tax advisory perspective, and we'll be sending out a summary, and we'll, as we get more detail, then there'll be further thoughts on everything. So thanks again for joining me, guys, and hope you enjoy the rest of your day. Thank you.
Thank you.